Hey folks, let me ask you something before we get into numbers, charts, or predictions. What if everything you think you know about the market right now is wrong? What if the fear you feel when you hear the word crash is exactly what's costing you money? And the optimism you hear on TV about a soft landing is quietly putting your future at risk? Because right now, millions of Americans are asking the same question in silence. Is 2026 going to bring a market crash or a market rally? And more importantly, what does that mean for you, your savings, your retirement, and your ability to sleep at night? My name is Leo, and today we're not doing hype, opinions, or guessing games. We're walking through the actual data, the real trends, and the quiet signals that most people miss. Not to scare you, not to excite you, but to help you think clearly in a time when clarity feels rare. Because the truth is, the biggest financial mistakes don't usually happen during crashes or rallies. They happen in the years leading up to them. Let me take you back for a moment. In 2006, the US stock market was calm. Too calm. Housing prices were rising, unemployment was low, and most Americans felt confident. Very confident. By 2007, cracks were already forming, but almost no one wanted to see them. And in 2008, we all know what happened. Fast forward to 2020, the market crashed faster than it ever had in history. And then something strange happened. It rebounded faster than anyone expected. People who panicked and sold locked in losses. People who stayed calm recovered. Now here we are again. Different decade, different headlines, same human emotions. So let's slow this down and look at what the data is actually telling us as we move toward 2026. First, let's talk about the economy itself. As of the mid-2020s, US GDP growth has been uneven. Some quarters show strength, others show slowdown. This isn't a booming economy, but it's not collapsing either. Consumer spending remains surprisingly strong, even though inflation has taken a toll on purchasing power. That right there is important. Americans are still spending, but they're doing it differently. More credit card usage, more buy later, less margin for error. Credit card balances in the US crossed $1 trillion for the first time in history. That's not a crash signal by itself, but it is a stress signal. When people rely more on debt just to maintain their lifestyle, the system becomes more fragile. At the same time, unemployment remains relatively low compared to historical averages. That's usually a positive sign. But here's the nuance most headlines ignore. Job growth has been concentrated in fewer sectors, while layoffs have quietly increased in tech, finance, and white-collar roles. These are often higher-income jobs. When higher earners feel pressure, spending patterns change, markets react, and confidence shifts. Now, let's talk about inflation, because this is where the story really starts to matter. Inflation may not dominate headlines like it did a few years ago, but its effects are still very much alive. Even moderate inflation compounds over time. A steady 3% inflation rate cuts your purchasing power nearly in half over about 24 years. That means a dollar saved today is quietly shrinking if it's not working for you. And here's where people get stuck. They hear market uncertainty and think the safest move is to sit in cash. Emotionally, that makes sense. But mathematically, long-term cash-heavy strategies during inflationary periods have historically led to loss of real value. Now don't misunderstand me. Cash has a purpose. Liquidity matters. Stability matters, but parking everything in cash because you're afraid of a crash is rarely the winning move. So what about interest rates? The Federal Reserve spent years raising rates aggressively to fight inflation. Historically, rate hikes slow the economy with a lag, not immediately. Sometimes the real impact shows up years later. That's why some analysts argue that 2026 is when we may see the full economic effect of past rate decisions. Slower growth, more pressure on corporate earnings, tighter credit. And yes, those conditions can increase the risk of a market correction or even a recession. But here's where it gets interesting. Markets don't crash just because things are bad. They crash when reality is worse than expectations. Right now, expectations are mixed. Some investors are optimistic about technology, artificial intelligence, productivity gains, and innovation. Others are deeply concerned about debt, deficits, and geopolitical risk. This split creates volatility, not certainty. Now let's look at the stock market itself. US stock valuations, especially in large-cap stocks, remain above historical averages. That doesn't mean a crash is guaranteed, but it does mean future returns may be lower than what people got used to in the 2010s. In the past, when valuations were high and interest rates were rising, markets tended to experience periods of sideways movement, sharp pullbacks, and uneven gains rather than straight-up growth. That's not a crash story. That's a patience story. So will 2026 bring a crash? The honest answer is, no one knows for sure. But we do know this. Crashes are rare, corrections are common, and long-term rallies are built during periods of uncertainty, not comfort. Here's a statistic that might surprise you. If you missed just the 10 best days in the market over a 20-year period, your total returns could be cut nearly in half. And many of those best days happen during or right after market downturns, when fear is highest. This is why timing the market is so dangerous. Now let's talk about what all of this means for you, practically. If you're in your 20s or 30s, your biggest asset isn't your portfolio, it's time. Volatility is not your enemy. Emotional decisions are. If you're in your 40s or 50s, sequence of returns risk becomes real. That means how the market performs near your retirement date matters more than long-term averages. Strategy matters. Diversification matters. Income planning matters. If you're already retired or close to it, this conversation becomes even more personal. It's no longer just about growth, it's about sustainability, cash flow, protection. This is where many Americans feel the most anxiety. They ask themselves quietly, what if the market crashes right after I retire? That fear is valid, but the solution isn't hiding from the market. It's building a plan that doesn't depend on perfect timing. Historically, retirees who combined diversified investments, flexible withdrawal strategies, and income-focused planning fared better through market downturns than those who tried to predict crashes. Now let me say something important here. This channel isn't about telling you what to buy or sell. It's about helping you think clearly when emotions are loud. If you're finding value in this kind of calm, data-driven conversation, staying connected here makes sense. These are the kinds of discussions that matter more over time than daily headlines. Now, let's zoom out again. What could support a rally into 2026? Productivity gains from technology are real. Corporate balance sheets, while pressured, are still stronger than in past crisis periods. The U.S. economy remains resilient compared to many others globally. What could trigger a downturn? Debt, government deficits, geopolitical shocks, policy mistakes, consumer exhaustion. So the real story of 2026 is not crash versus rally. It's adaptation versus reaction. The people who do well financially aren't the ones who guess the future perfectly. They're the ones who build systems that can survive multiple futures. That means keeping some liquidity, staying diversified, avoiding extreme bets based on fear or hype, reviewing your plan regularly, not emotionally. It also means understanding that doing nothing is still a decision. One quiet but powerful idea to consider is this: focus less on predicting the market and more on improving your financial position, regardless of what the market does. That could mean reducing high-interest debt, increasing your savings rate, understanding where your money is actually invested, building skills or income streams that aren't tied to market cycles. Those moves matter whether the market crashes or rallies. And here's the part most people don't talk about. Financial peace doesn't come from knowing what the market will do next year. It comes from knowing you're prepared for whatever it does. As we move closer to 2026, the noise will get louder. Headlines will get more extreme. Opinions will get more confident. But confidence without humility is dangerous in markets. So stay curious, stay patient, stay grounded. If this conversation made you think differently, if it helped you slow down and see the bigger picture, that's the goal here. And before you go, take a moment to let me know your thoughts. Do you feel more concerned about a crash, or more optimistic about a rally? Those perspectives matter, and the discussion helps everyone think more clearly. If you found this valuable, supporting the channel helps more than you might realize. A simple like tells the algorithm this kind of content matters. Sharing it helps someone else who might be quietly worried about the same things. And subscribing keeps you connected to future conversations like this one. This is Leo. Thanks for spending this time with me.